Hi everyone, this is Victor here. Welcome to the Intelligent Investor channel. Several members asked me to analyze Netflix stock to see if it's a great stock for the long term. Netflix stock did very well in the past 5 years. For example, it increased as much as 421.4% in the past 5 years. Obviously, past performance does not guarantee future results. We need to look at Netflix's future growth prospects instead of looking at its past. Personally, I want to find out whether Netflix will still be a multi-bagger stock over the next 5 to 10 years. So in this video, I'm going to talk about these topics. First, what is Netflix's business model? Second, Netflix two growth catalysts over the next 5 to 10 years. I will talk about Netflix focus on international membership growth and its content strategy. Third, Netflix major competition and risks. I will talk about Netflix two major risks you should know about. Fourth, what is Netflix fair interest and value? You will learn about how to value Netflix stock to find its fair interest value per share. And fifth, will I buy Netflix stock? If you like this video, hit the like button, subscribe and turn on the notification button. I will continue to make many excellent stock analysis and investing analysis videos every week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a premium member. Our goal is to create the best intelligent investor community that will help all our members grow their stock portfolios to over 7 figures over time. With your support, we will be able to stay independent, hire other outstanding analysts to cover different stocks, and create many excellent stock analysis and investing videos every week that will help you become a great investor. The link is in the video description. Take a look, let's start. So what is Netflix's business model? Netflix's business model is very easy to understand if you're already a Netflix member. Netflix earns all its revenue from monthly membership. If you want to watch Netflix shows, whether it is Netflix original content such as Squid Game, The Witcher or Money Heist, or third-party movies and TV shows, you will pay a monthly membership fee. For example, if you're in the US, you will pay $18 every month for the premium plan. And if you're in Canada like me, you will pay $19 every month for the premium plan. Netflix has 214 million global paid members at the time of making this video. The pandemic benefited Netflix a lot in 2020 because it forced many people to stay at home and stream TV shows and movies online using Netflix. If you look at these weekly global paid net adds here, you can see Netflix had the fastest membership growth in 2020. But now in 2021, you can see Netflix paid net membership growth is much lower now compared with the previous 4 years because of the pull forward effect from 2020. Here is the important part you will want to know. Netflix paid membership base is much larger at 214 million now. Going forward, we should not expect Netflix to have the same high revenue growth and net membership growth as before. Also, we should not expect Netflix stock to grow as fast as in the past 5 years. Here is another indication that shows Netflix revenue growth and paid membership growth are decelerating. If you look at the most recent Q3 shareholder letter, you can see Netflix Q3 year-over-year revenue growth of 16.3% and paid membership year-over-year growth of 9.4% are much lower than the past 4 quarters. Obviously, Netflix had an exceptional year in 2020. Netflix had gained millions of paid members much earlier than it would normally gain because of the pandemic. This is what we call the pull forward effect. Going forward, we should not expect Netflix paid membership to grow as much as 20% year-over-year every quarter. Realistically, I believe Netflix paid membership should grow around 10% each year over the next 5 years, which is similar to Netflix Q3 membership year-over-year growth here. Here is another important part you want to know about Netflix business model. Netflix used to lose a lot of money every quarter and used to spend much more cash than it could generate every quarter because Netflix has very high content cost to make its original content and to pay for third-party licensed content. For example, if you look at Morningstar here, you can see Netflix had negative operating cash flow and negative free cash flow in 2018 and 2019 because Netflix has very high content cost. Before 2020, Netflix could not generate enough cash to pay for all its content every quarter. Netflix had to issue a lot of debts to finance its growth. Netflix actually has much more debts and content obligations than it shows on its balance sheet. For example, if you look at this table here, you can see Netflix has a total of 48 billion in content obligations, debts, and other obligations. Some of the content obligations are not yet reflected on Netflix's balance sheet because, for accounting purposes, they have not yet met the criteria for asset recognition. In comparison, Netflix has $7.5 billion of cash and $27.4 billion of total liabilities as of Q3 this year. In my opinion, $48 billion is a lot of debt compared with Netflix's $7.5 billion of cash. This means Netflix will rely on its monthly membership revenue to pay off all its content obligations and debts over time. Netflix management believes that it no longer needs to raise external financing, meaning debts or new shares, to fund its day-to-day operations. Let's talk about Netflix's two long-term growth catalysts before we talk about Netflix's competition and risk. I believe Netflix's first long-term growth catalyst is its international membership expansion outside of the North American market. As of now, Netflix's North American market is very mature and has a high penetration rate. This means the largest membership growth will be outside of the US and Canada going forward. This is from the most recent Q3 shareholder letter. For the second consecutive quarter, the APAC region was our largest contributor to membership growth with 2.2 million paid net adds, half of total paid net adds, as we continue to improve our service in this region. In EMEA, paid net adds of 1.8 million improved sequentially versus the 188,000 in Q2 as several titles had a particularly strong impact. The UK and Latin American regions grew paid memberships more slowly. Netflix added 73,000 net members in the US and Canada markets in Q3 this year. During the same period, the European market or EMEA added 1.8 million net members. The Latin American market added 330,000 net members, mainly because Netflix recently increased its pricing in Latin America. And the Asia Pacific market, which I believe has the biggest growth potential, added 2.2 million net members. To be fair, Netflix still earns the most revenues from the North American market and the European market. As an investor, you want to know what will be Netflix paid membership growth going forward. This graph shows Netflix paid net membership growth each year from 2017 to 2021. 2020's growth was an outlier for Netflix. Netflix added millions more paid net members much earlier than it would normally take Netflix to acquire under normal market conditions. But if you look at the annual net member growth between 2017 and 2019, you can see Netflix's annual net member growth was between 20 and 30 million each year under normal market conditions. Going forward, I believe it will take Netflix 7 to 10 years to double its current paid membership base from 240 million to 400 million plus. This is assuming Netflix will add 20 to 30 million paid net members each year over the next 10 years. The main growth catalysts will be mainly from the international markets such as the Asia Pacific market, the European or EMEA market, and the Latin American market. These markets are still not fully mature yet. Management said this in the latest earnings call, so we think we have a super long runway here to adjust those upwards of 1 billion paid TV households or broadband households, however you measure it around the world. I believe Netflix's second long-term growth catalyst is its original content, specifically local content, and its upcoming gaming strategy. As of now, Netflix is focusing a lot more on local content in different markets, so Netflix can capture more membership growth from the international markets such as the Asia Pacific and Europe that have a lot of growth potential. For example, Squid Game from Korea has become Netflix's most popular TV shows at the time of making this video. Management said this about its local content strategy. We are now producing local TV and film in approximately 45 countries and have built deep relationships with creative communities around the world. While the goal of our local content executives is always to create locally authentic stories that will resonate in their country, like the Chestnut Match, which we expect to be watched by approximately 2/3 of our Danish members during its first 4 weeks. Netflix is a global direct-to-consumer service which enables creators to reach broader audiences and gives our members an even greater choice of stories to enjoy. There is no better example of this than Squid Game, a unique Korean story that first captured the zeitgeist in Korea and then globally. Released on September 17th, it has become our biggest TV show ever. A mind-boggling 142 million member households globally have chosen to watch the title in its first 4 weeks. Going forward, one of Netflix's main strategies is to develop more local content for different markets. Netflix either makes its own original content or buys licensed content from other studios. Based on my personal preference using Netflix, I believe Netflix has much better video content than other competing streaming services, such as Amazon Prime Video. Netflix seems to have the best algorithm to know what TV shows and movies members are interested in the most. I also noticed Netflix has a lot more international content from Korea and other international markets. In terms of of gaming strategy, Netflix management said this in the recent earnings call. As a reminder, games on Netflix will be included in member subscriptions and will not have advertisements or in-app purchase, so gameplay is purely focused on enjoyment versus monetization. If you think about license to partner produce to self-produce, there's multiple avenues that we get to producing incredible entertainment experiences for our members. I think we're going to take a similar approach with games, which will have multiple different approach, including an internal game development capability. So we want to build that up, and one of the ways to sort of accelerate that process is when we find the right opportunities through acquisition, and that's what we did with Night School. Right now, it's too early to tell whether Netflix gaming strategy will be a success. Netflix's current gaming strategy is not cloud gaming, not streaming games to our smartphones. Netflix's current gaming strategy is to make casual mobile games tied to Netflix's popular franchise such as Stranger Things. You still need to download Netflix mobile games on the Android App Store like any other mobile apps, so this is not cloud gaming. Netflix's gaming strategy may change later to perhaps actual cloud gaming, but again, it's too early to tell right now. In terms of risk, Netflix's biggest risk is increasing competition with Amazon Prime Video, Disney+, Hulu, that's also owned by Disney, HBO Max, Apple TV+, and many other local streaming services around the world. Content is the king in streaming services. It's very easy for members to cancel Netflix membership and move to Amazon Prime Video, Hulu, HBO Max, Disney+, and Apple TV+, if members don't like Netflix content. Again, based on my experience using Netflix, I believe Netflix has the best video content and the best algorithm to predict what TV shows and movies members are interested in the most. I believe Netflix original content is its biggest competitive advantage since they are not available on other streaming platforms. Netflix won more Emmys than other networks and platforms for the first time with 44 awards total in 2021. This shows Netflix video content tends to be much better than other streaming services. I believe Netflix's second biggest risk is its high content costs and high debts. If we add all of Netflix's content obligations, debts, and other obligations here, Netflix has 48 billion of obligations and debts as of Q3 this year. This is much higher than Netflix's 7.5 billion of cash and 27.4 billion of total liabilities on its balance sheet. Netflix management said this, as we discussed previously, we believe we no longer have a need to raise external financing to fund our day-to-day operations. During the quarter, we repurchased 0.2 million shares for 100 million. Our slower buyback pace this quarter reflects the pickup in our merger acquisition activity. As a reminder, we prioritize our cash to reinvest in our core business and to fund new growth opportunities like gaming, followed by selective acquisitions. After satisfying those uses of cash, excess cash above and beyond our minimum cash levels will be returned to shareholders via stock repurchase. This is an important inflection point because Netflix management believes that the company will have enough cash flow to pay for its high content cost and its day-to-day business operations without relying on issuing more debts going forward. Let's talk about Netflix fair intrinsic value. As of now, Netflix does not have consistent free cash flow growth every quarter yet, so we cannot use the discounted cash flow DCF model to estimate Netflix fair intrinsic value per share. The DCF model works very well if the company has consistent cash flow growth every year. I also cannot use the comparable valuation model to estimate Netflix fair intrinsic value because other comparable streaming services such as Amazon Prime Video and Disney Plus are owned by companies that have very different business models than Netflix. For example, Amazon's core businesses are e-commerce and Amazon AWS cloud service, even though Amazon owns Amazon Prime Video. So I cannot use Amazon as a comparable to estimate Netflix fair intrinsic value per share. This means I have to use a different valuation model to estimate Netflix fair intrinsic value. Let me show you this Netflix intrinsic value calculator here. Netflix market cap is mainly dependent on Netflix total paid members and paid net member growth every quarter. As of Q3 this year, Netflix has 240 million paid members. As long as Netflix total paid members continue to grow every quarter, Netflix fair intrinsic value will also increase every quarter. Here is how I estimated Netflix fair intrinsic value using market value per member here. If we divide Netflix's current 294 billion market cap by the most recent quarter's 214 million paid members here. The market value per member is $1,377.69 at the time making this video. I have to use billions instead of millions here to match Netflix market cap that is in the billions. For the past 4 quarters, Netflix market value per member was $1,119.66 in Q2 2021, $1,112.7 in Q1 2021, $1,172.98 in Q4 2020, and $1,130 in Q3 2020. The average market value per member over the past 4 quarters is $1,133.83. In comparison, the current market value per member is $1,377.69 at the time making this video. This means Netflix stock is likely overvalued by around 21.51% now. To estimate Netflix fair interest value per share, I multiply Netflix $1,134 average market value per member by the most recent 214 million paid members here. Based on my estimate, Netflix's current fair value should be around $242 billion for the entire company, or $547 per share. Again, this means Netflix stock should be overvalued by around 21.51% at the time of making this video. So will I buy Netflix stock? Yes, I will buy Netflix stock if it drops below its fair intrinsic value, because I want a much larger margin of safety to reduce risk. I don't have Netflix shares in my growth portfolio now. I made the mistake of selling Netflix before, so I'm planning to buy it back later on. Based on my estimates I talked about earlier, I believe Netflix fair interest value is around $242 billion for the entire company, or $547 per share. As Netflix adds new paid net members every quarter, I believe its fair interest value per share will also increase. Now, all these estimates and analysis are based on my research. They are not financial advice. Make sure you do your research and do your extra due diligence first before investing in anything. If you like these videos, hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing analysis videos every week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a premium member. Our goal is to create the best intelligent investor community that will help all our members grow their stock portfolios to over 7 figures over time. With your support, we'll be able to stay independent, hire other outstanding analysts to cover different stocks, and create many excellent stock analysis and investing videos every week that will help you become a great investor. The link is in the video description. Thank you for watching this video. This is Victor from the Intelligent Investor channel, and I will see you in the next video.